All right, good afternoon, class. Let's welcome ourselves to our classroom on variance analysis, standard costing. My name is Femi Richworld Aiyeolowo. I am representing Speedy Success Professional, the professional team providing the best of professional accountancy training, accountancy services, auditing, taxation, and consultancy. You are watching my video for the first time. Our topic is variance analysis. And please subscribe. Subscribe to see all other professional lectures that we have been able to do on this platform. Now, today we look at the various formulas on variance analysis. And as I start, let's look at the basic variances. The first one is sales volume variance. Sales volume variance. The second is sales price variance. And the third is variable cost variance. And the last is fixed overhead cost variance. Now let me remind us that the variance simply means the difference between the standard cost and the actual result. The difference between the standard cost or the budgeted cost and actual results. Are we together? And for professional accountancy, variance analysis is very necessary for what I call accurate performance evaluation in our various entities. Let's look at some of the formulas. We have the first group, sales variance. It's divided into three groups. Sales variance is meant to determine sales margin variance, and which will give us standard contribution against actual contribution. So we say sales margin variance is equal to standard margin. The word margin there is sales minus variable cost. Sales minus variable cost will give you margin. So we have standard margin minus actual margin will give us sales margin variance. And this is divided or subdivided into two other areas where we have sales price variance and sales volume variance. Sales price variance, actual sales at the actual selling price minus actual sales multiplied by standard selling price. Are we together? That's the first one. So the first variance we will find is what we call sales variance, and it's divided into three: sales margin variance, sales price variance, and the last is sales volume variance. Let's look at sales volume variance. Now, when we say sales volume variance, we simply mean the difference between the actual sales volume in unit minus the budgeted sales volume in units. Sometimes the budgeted can be higher and sometimes the actual can be higher. Variance is actually the difference between the budgeted and the actual. Why do we learn variance analysis? I told us in our first class, which I would like you to watch the video, variance analysis part 1. This is part 2. Remember to subscribe to my video. My name is Femi Richworld Aiyeolowo, Speedy Success Professional. Subscribe. And you need all those services, please call 0814842 1111. 0814842 1111. Now, the second part is cost variance. And this cost variance is divided into material costs, labor costs, and then overhead. Now let's look at material cost. Material cost variance is simply material cost is equal to standard cost minus actual cost. That is, material cost variance is standard cost minus the actual cost of material for the period. Are we together? And this is subdivided into price variance. Every time there is price changes, there will be variance. So we have price variance is simply mean actual quantity bracket standard price minus actual price, taking the actual quantity to multiply the difference between the standard price and the actual price. And that is how to calculate material price variance. Let's move to usage variance under material, where prices change or prices are constant, sometimes volume of usage may be different. All right, so let's look at that. All right, material usage variance simply means the application of standard price against the difference between standard quantity and actual quantity. That is, standard quantity minus actual quantity multiplied by standard price. It will give you usage variance. So the combination of usage variance and price variance will give us material cost variance. Ladies and gentlemen, let's go to labor wages or labor or wages cost variance. Remember to subscribe. Loving to learn this topic, please subscribe. Student of accountancy, performing accountant, please subscribe. Let's go. Now we're looking at wages or labor cost variance. We say labor cost variance is equal to standard labor cost minus actual labor cost. Standard labor cost minus actual labor cost, which is divided into three areas. Labor rate variance, which is actual hour that is used, less multiplied by the difference between standard rates of labor minus actual rate of labor. Actual hour used multiplied by the difference between standard rates minus actual rates. That is labor rate variance. Let's look at labor efficiency and idle time. Now we move ahead. Well, at the second part or the third part of labor variance is labor efficiency variance. How efficient the labor used is also a determinant of performance or productivity of a company. Labor efficiency variance is calculated as standard rate of labor multiplied by the difference between standard hour budgeted and actual hour used. Standard hour minus actual hour multiplied by standard rate, which will show us the labor efficiency variance. Idle time is the last one here. Idle time variance also shows the number of idle time that exists per day or per period in the factory. And idle time majorly can be caused by things like machine breakdown, can be caused by setup period, can be caused by lack of certain material, and so these are calculated as standard rate bracket the difference between standard hour and minus actual hour that is used. Now we move ahead. We move to variable overhead variance. Do not forget to subscribe to Speedy Success Femi Richworld lecture notes on performance management and all the accountancy courses. Remember, you will need our services to help develop your account department or train your staff or your auditing, taxation. You will need to outsource your account department. Please call 081-4842-1111. My name is Femi Richworld. Aiyeolowo. Now listen, variable overhead variance is calculated as standard variable overhead variance cost minus actual variable overhead cost for the period, and then it's subdivided into two other areas, which include variable overhead expenditure variance, which is calculated as actual hour that is used multiplied by the difference between standard rate of labor, which is the absorption, the unit of absorption, minus actual rate of labor. Remember, for those of us who have learned absorption costing, we have set out in such traditional model, labor R is commonly used in absorbing overhead to our production. So next one is variable overhead efficiency variance, which is standard rate of labor multiplied by the difference between standard hour minus actual hour that is used. And this is how to calculate efficiency. Ladies and gentlemen, as we move ahead, remember to subscribe. We're moving to the last line, fixed overhead variance. All right, the last one here is fixed overhead variance. Simply, it's the difference between standard cost or standard fixed overhead cost minus actual fixed overhead cost for the period. And this is subdivided into four different areas. The next there is fixed overhead expenditure variance, which is budgeted fixed overhead minus actual fixed overhead. Remember, fixed overhead is constant for the period, except otherwise stated in fixed overhead is not expected to move in short period, except in the long period. So in the short period, where we have this performance evaluation, we expect that fixed overhead should be constant. And where the actual result is different, we have fixed overhead expenditure variance. Let's take the next line. Fixed overhead volume variance is simply calculated as standard rate bracket the difference between standard hour minus budgeted hour, and that will tell you how much volume that has probably changed in the period of production. Number 4, fixed overhead efficiency variance is calculated as standard rates of labor or absorption multiplied by the difference between standard hour minus actual hour that is used in the factory, minus the word AU mean actual hour. Are we together? The last line is fixed overhead capacity variance. Fixed overhead capacity variance is known as the difference between standard rate, the difference between budgeted hour minus actual hour used multiplied by standard rate. Ladies and gentlemen, one more time, let's go through. This is variance analysis, and I have decided to do all of this because I know a lot of candidates are very skeptical or afraid of variance analysis even in the offices. So please kindly look through. I'll go through them one by one again so that you can write down the formulas, and if you have a practice question, go and test yourself on it. Very smart, very straightforward. You will be able to get your answers easily. Are we together? Now we move. So we move to this. Says volume. Just keep watching. Write your notes gently. Remember to subscribe to Femi Richworld Speedy Success Professional Studios and engage us for your accountancy solutions. You want solutions please call us 08148421111. Nigeria +234. You are calling from outside Nigeria +234 8148421111. When we meet the next class, I will show you the advanced variance analysis. Thank you. God bless you. Bye.